There's only 6 types of investments you can purchase in your TFSA, which are not going to be taxed. They are cash, stock exchange securities, mutual funds, GICs, bonds, and some small business shares. Otherwise, you can get fined or be subject to taxes. So long as you're a Canadian resident over the age of 18, you'll be able to invest in a tax-free savings account. The TFSA is an account where you're able to save some money for your future, while completely being exempt from any sorts of taxes, as the name implies. There's no catch to it, except for a limit on the contributions. The government really just wants you to save, okay? As a matter of fact, according to the Bankrate statistics, they found out that on average, 22% of the US population doesn't have any savings, and 30% who have some savings, but not enough to cover themselves for 3 months. Similarly, in Canada, the situation is not that much better, with the Ontario Pension Plan reporting that 44% of pre-retirees have no more than $5,000 saved. Needless to say, the numbers speak for themselves. The problem is really a combination of 2 things, mostly being the fact that wages are not keeping up with inflation, rent, and other complications with the economy like unemployment. Or, in other words, the government just sucks at their job. But the second reason we people don't invest is because it's uninviting. Taxes, uncertainty, and just how distant the investing world can be. People just don't want to invest and save because it's just too complicated. To remedy this issue, the government has introduced the TFSA in 2009, or in the US, its equivalent, the Roth IRA, to ease us into saving. Because the logic for them behind this is that down the line, it'll be much easier and cheaper to pay out pensions to retiring people who already have a safety cushion under them from the prior year's savings. And doubly so, it serves as an emergency fund which can reduce the strain on our welfare systems when life gets tough. You know, like when you get laid off from work because something like COVID happens and you have no control over it. And who knew at the time how long it would last? Judging by how people started hoarding toilet paper, I wouldn't be surprised that many believed it to be the end of the world. So, it's in situations like these that we and our governments want to make sure we have something in our piggy banks to help us sustain ourselves. Now you can start to see how the TFSA is a win-win for everyone involved. The purpose of this video is to bring light to the TFSA, to draw more awareness, and by explaining what you can invest in, to demystify this investing world one piece at a time. So, one by one, the 6 investment types you can hold in your TFSA are cash, stock exchange securities, mutual funds, GICs, bonds, and some small business shares. Cash, as its name implies, is just money. You can open a TFSA with your bank and just deposit your money from your checking account. Stock exchange securities, which are basically anything that's listed on the stock market. You see the tickers like the New York Stock Exchange or the Nasdaq, or in Canada we have the TSX, Toronto Stock Exchange, where all the stocks are traded. You don't have to physically be there to buy or sell something, but they are the platform on which companies that go public list their shares. Here, you can buy individual stocks, which is like purchasing a very small piece of a company. Things like Apple, Meta, Amazon, and so on. And once you buy it, you're essentially riding the wins and losses of the company together with them. That's investing 101. Revenues are up, good public sentiment, then your stock should go up. Losses and catastrophic business failure, then expect your stock to go down. Stocks are not, however, the only thing you can purchase on the stock market. Another very common and useful security you can purchase is an ETF, which is short for Exchange Traded Fund. These are funds that track an index performance of some kind. You're basically getting a packaged bundle of stocks in one purchase, and they act in the same way as a regular company stock would. You've probably heard of these before somewhere on the news or elsewhere. The most well-known, of course, being the Dow Jones or the S&P 500, which tracks the top 500 companies in the US. So, with one share of the S&P 500, you're getting exposed to the biggest companies in America, their ups and their downs. And I will mention, when you're buying an ETF, you're not paying the full price of each stock combined, but only a fraction, and therefore receiving only a fraction in return. Right? So it's a great way for any investor to diversify their portfolio by not putting all of your eggs in one basket, but in a broader market at a reduced cost. Also in the stock exchange group are derivatives and futures. Essentially, they're more volatile and leverage returns a lot more. It's the sort of stuff you see on Wall Street bets, where people lose or gain hundreds of thousands of dollars. As for the TFSA, you wouldn't be allowed to invest in these to the extent that your portfolio risks going into the negative. Next up, mutual funds. Professionally managed investment companies you can buy into. Their entire existence and goal is usually to achieve long-term growth. And the way they do this is by employing professional people to do analysis, trading, and investing on the behalf of their customers. Mutual funds are a great way to relax and know that your money is invested somewhere safe and is actively managed by people who know their stuff. Usually. The one concern is that you'll have to be paying for their service, not with an upfront deposit, but with a significant % of your returns. It's not free, unlike the very low transaction fees you pay on stocks or ETFs. Following, we have GICs here in Canada, which stands for Government Insured Certificates. The thing about this investment is that you're guaranteed to get the money you deposited back, alongside a % return. Most of the time, they're non-redeemable until their maturity, which means it will have a date at which it expires and you receive your money and interest back. There are options for flexible GICs you can redeem at any time, but they usually have a lower interest rate attached. Think of it as though you're giving the bank a loan, right? The same way they're giving you money for your needs like shopping, rent, and everything when you use your credit card. Well, companies need capital and money too, especially banks because of their business model. So by purchasing a GIC, you're providing them with a loan they have to repay back on a term you agree upon, like a year or two. Speaking of loans, next on our list are bonds. They work in a similar way where their functionality depends on accumulating funds through credit. Bonds are issued by regular corporate companies, but also by our governments as a way to raise capital. They too, alongside GICs, are among the safest options in the investing world, but they're usually not talked about a lot due to their low returns. They are, however, really safe. Bonds guarantee you payments in the form of coupons. Coupons are the interest you're getting by loaning your money as an investment. The same thing applies to annuities you can purchase. The only way a bond can fail is if the company fails and defaults. Something that's very likely in a startup, but not so much with the government. Odds are, those guys are here to stay. You can purchase a bond in different ways, including some governmental services, but the simplest way is through purchasing an ETF, which I talked about earlier, tracking a bond index. And lastly, you can purchase small business shares. There's a lot of regulations and details about this, but in a nutshell, it boils down to it being a legitimate investment in which you're not the owner itself. This rule even extends to mortgages that you're not connected to. If you need some examples of things you cannot hold in your TFSA, you cannot hold land or your own business, and you cannot hold a corporation's debt or shares in which you have a 10% or larger stake in. And that's it. Hopefully you learned something. And if you've made it this far, I want to commend you for taking your personal finances seriously. You're way ahead of most people now. Remember how I said 1 in 5 people don't have any savings? Well, I'm sure at least some of those people have something to save, but they just don't have the time to devote it to personal finance. Totally understandable when the living from paycheck to paycheck lifestyle leaves no room to breathe. But if a little learning about finances was all you needed to start your investing journey, then I'm happy to have helped. Thanks for watching. Like and subscribe for more videos, and I'll see you all next time.